Hey everyone, welcome back to Corporate Decoder. Today, CWST just filed their quarterly report for the 3 months ending the 30th of June 2026, and I am seeing some big changes in their cash position. Quick note, this is not financial advice, just my take on public filings for educational purposes. Their recent acquisitions are significantly changing the balance sheet and the cash flow picture. This filing is their regular update for investors, a 10Q, and it covers the second quarter of 2026. It gives us a look at how Casella Waste Systems is doing right in the middle of the year. Let's dive into the numbers. On the asset side, cash and cash equivalents took a big hit. It dropped from about $124 million at the end of 2025 to just under $26 million by June 2026. That is a huge decrease, nearly 80%. This usually means the company spent a lot of money, likely on those acquisitions they've been making. On the flip side, their property and equipment, which includes all their trucks, facilities, and landfill assets, grew significantly. It went from about $1.3 billion to over $1.4 billion. This growth aligns with the spending we're seeing. And here is a big one. Goodwill. This number almost doubled, going from about $1.1 billion to over $1.3 billion. Goodwill on a balance sheet usually represents the premium paid for acquired businesses over their net asset value. This massive jump tells us Casella Waste Systems has been very active buying other companies, and they paid a premium for them. Overall, their total assets grew from about $3.3 billion to over $3.5 billion, showing expansion. Now let's look at the liabilities, their long-term debt. The part that is not due in the next year jumped from about $1.1 billion to over $1.3 billion. This is directly related to the acquisitions, as they likely took on more debt to finance those purchases. Despite the increase in debt, their total stockholders' equity actually went up slightly, from about $1.57 billion to over $1.58 billion. This suggests that while they borrowed money, the value of the company's assets, including the ones they acquired, grew even more. Moving to the income statement, revenues are looking strong. For the 3 months ending the 30th of June 2026, revenues were almost $544 million, up from about $465 million in the same period last year. That is a solid increase. Year to date, revenues also jumped from $882 million to over $1 billion. This growth is coming from both their solid waste operations and their resource solutions business. Their cost of operations also went up, as you'd expect with more business and acquisitions. It increased from around $308 million to $365 million for the quarter, and from $588 million to $674 million year to date. This is a key area to watch as they integrate new businesses and manage rising costs. Operating income, which is what is left after covering direct costs, stayed relatively flat for the quarter, around $20 million. For the 6 months, it actually increased slightly from about $22 million to $25 million. This indicates that while revenues are growing, they're facing pressure on their margins, likely due to those increased operating costs and the integration expenses from acquisitions. Net income for the quarter was about $3.8 million, down from $5.2 million in the same quarter last year. Year to date, they reported a loss of about $1.8 million compared to a small profit of $398,000 last year. This is a bit concerning, showing that despite revenue growth, the increased costs and acquisition expenses are eating into their profitability. This translates to basic earnings per S-Hair. For the quarter, it was 6 cents, down from 8 cents last year. Year to date, they are showing a loss of 3 cents per S-Hair, compared to a 1 cent profit last year. Now, looking at other comprehensive income, which includes unrealized gains or losses, they had a significant positive swing. This section moved from a loss of over $3,900 at the end of 2025 to a gain of $560 by June 2026. This was largely driven by positive changes in their hedging activities, particularly interest rate swaps. Let's examine their cash flow statement. Net cash provided by operating activities was about $161 million for the first 6 months of 2026. This is up from about $140 million in the same period last year. This is a positive sign, showing their core business operations are generating more cash, which is crucial for funding their growth. However, their investing activities show a massive outflow. They spent over $522 million on acquisitions and additions to property and equipment. The acquisitions alone accounted for almost $401 million in the first 6 months of 2026, a big jump from $175 million last year. This confirms the aggressive acquisition strategy we saw reflected in the goodwill on their balance sheet. To fund all this, their financing activities show they borrowed a lot. They had net cash provided by financing activities of $170 million, largely from taking on new debt compared to using cash in financing activities last year. Specifically, they borrowed about $249 million in new debt. The combination of increased spending on acquisitions and capital expenditures, while also paying down some debt, led to a significant decrease in their cash. Their cash and cash equivalents dropped by nearly $191 million. This aggressive growth strategy is heavily financed by debt. Their senior secured credit facility, which includes a term loan and a revolving credit facility, is substantial. As of the 30th of June 2026, they had about $800 million in the term loan and $185 million drawn on their revolving credit facility. The revolving credit facility has a total capacity of $700 million, meaning they have quite a bit of borrowing power left. They have to maintain certain financial ratios. Their maximum consolidated net leverage ratio was 2.7. Well below the covenant requirement of 4.0. This means they are currently meeting their debt obligations comfortably. Looking at segment reporting, solid waste revenues are showing strong growth. For the quarter, they increased by over 18% compared to last year. Year to date, solid waste revenues grew by 14.4%. This growth is driven by a combination of price increases, higher fees, and importantly, the revenue from their recent acquisitions. Resource Solutions revenues also saw good growth, up 10.7% for the quarter and 9.5% year to date. This segment includes their processing and national accounts businesses. However, operating income tells a slightly different story across segments. The Western region saw a significant increase in operating income, up about $7.4 million for the quarter and $11.8 million year to date. But their Resource Solutions segment saw operating income drop by $3.4 million for the quarter and $4.3 million year. To date, the corporate entities segment, which houses general overhead, also saw its operating loss increase. One area of ongoing concern for waste management companies is fuel price risk. Casella Waste Systems is no different. They estimate that a 50-cent per gallon change in diesel fuel prices could impact their costs by about $9 million annually, though they have programs to recover some of these costs through customer fees. They also have significant exposure to interest rate risk due to their substantial debt. They've used interest rate swaps to hedge against variable rates on about $515 million of their debt. A 100 basis point change in interest rates on their remaining variable rate debt could impact their interest expense by about $4.7 million annually. The company states their management, with the Chief Executive Officer and Chief Financial Officer, evaluated their disclosure controls and procedures and found them to be effective. This means they believe their systems are in place to ensure accurate reporting. Finally, looking at the exhibits, there is an offer letter for a new executive, Damien A. Rybar, dated the 27th of June 2026. This suggests leadership changes or additions are happening within the company. Looking at the bigger picture, Casella Waste Systems is clearly in a growth phase, aggressively pursuing acquisitions. This is driving revenue growth, which is positive. However, this expansion comes at a cost. Their net income is down, and they've taken on significantly more debt. The key challenge for them will be integrating these acquisitions effectively, managing rising operating costs, and ensuring that the acquired businesses contribute positively to profitability. Not just revenue, they are meeting their debt covenants now, but with their aggressive borrowing. That is something to keep an eye on, especially if interest rates continue to rise. The substantial increase in goodwill also means there is a lot of value tied up in acquired companies, and any future impairment of that goodwill would hit their balance sheet hard. And the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.